Understand more from the management itself. We have been joined by Mr. Shanti Lal Jain, MD and CEO of Indian Bank. Very good morning, Mr. Lal, and thank you so much for your time. Let me just start by asking on your numbers and especially your profits, which have seen a growth of 40%, but this was largely led by lower provisionings this particular quarter. If I see your slippage ratio, then that is also low on a YOY basis, but overall NPAs are at a multi-period low. Will the same level of asset quality continue going ahead as well? And what's your take on that?
So our net profit has grown by 41%, from 1,709 to 2,403. The net profit has grown on the strength of the growth in operating profit, which has grown by 8%. And operating profit has grown on the strength of the NII, net interest income, which also has grown by 8 to 9%. Non-interest income too has grown by 11%. So, and that both this net interest income is growing based on our business growth and maintaining CASA. So this profit is coming from the core operations. The profitability will continue to happen. Now the point is the gross NPA and the net NPA and the asset quality. So our collection efficiency, we are maintaining 95%. And as far as slippage and recovery is concerned, our story for recovery more than the slippage is continuing. And third point is when the net NPA itself is 0.39, so the credit cost will come down. So going forward, when your businesses is growing, CASA is growing, asset quality is in better hands, so now the profitability should be better.
Good morning, Mr. Jain. This is Cheryl also joining in the conversation. And Indian Bank's actually given a target for NIMs of approximately 3.4 to 3.5%. There is a pressure on NIMs when you talk about the entire banking system as a whole, isn't it? So although it's still within the limits, do you foresee any further compression in NIMs in the near term, given the trend or the commentary that we are seeing in the banking industry?
At the beginning of the year, we said that margins will be 3.4 to 3.5, of course, with a plus minus 10-15%. In the current quarter, our margin, we could be able to maintain our margin at 3.53%. Going forward, of course, we are living in a very tight market where for a growth of the business, naturally you need to raise resources in the shape of term deposit. And so margins may not be on the same range going forward, but our endeavor will always be to remain within our range, which we are given 3.4 to 3.5. And naturally, we always perform better than the guidance.
Also, Mr. Lal, you reported healthy advances growth. The CD ratio went up, but although it's still in the comfortable levels, but now that the regulators have become vocal about the concerns around this, so do you anticipate your CD ratio to go up?
So the point is that you see our CD ratio is 79%. And you see from last 1 year, or even you see March, our deposit and credit growth is matching. In fact, in terms of absolute number, we have grown by 60,000 crore both in deposit and advance. Of course, since the incremental CD ratio is 100%, so naturally your CD ratio is inching up. But as far as liquidity is concerned, we maintain the liquidity. We have a 43,000 crore of excess SLR. So we will raise deposits based on the need. And in this process, 1 or 2% here and then LDR can happen.
Right. Mr. Jain, what's your internal assessment on the latest RBI's draft guidelines on the liquidity coverage ratio? If you could tell us any impact that you've assessed so far on the LCR ratios going ahead?
So this draft guidelines have come for LCR. 2 point is the runoff factor has increased by 5 bips, right? And as a result, naturally, your outflow will be more in that situations. And at the same time, on a HQLA side, also the 5 discounting factor is to be factored in. Resulting in the current situation, we will be having impact of around 5%. Presently, we are at a LCR of close to 120%. So it will have an impact of 5% in our book. And of course, it is still, we are at 115%. So we are managing our liquidity.
But also, Mr. Lal, you managed to maintain your ROA above 1% for the second consecutive quarter now. So can we expect this to remain above 1% in the coming quarters as well? And if so, then what are the levers to drive your ROA growth further?
So at the beginning of the year, we said that ROA will be more than 1%. You see the last quarter, it is 1.15 and this quarter is 1.20. When the credit cost is controlled, slippage or recovery is more than the slippage, naturally the ROA and our businesses are growing with the margins. So ROA is, we are saying that we'll continue to have our guidance of more than 1% ROA in going forward as well.
Right. Let's talk about MFI segment. Are you seeing any stress building up in the MFI book, Mr. Jain? Because we've actually been hearing about this from some of the banking peers.
No, you see our slippage is around 1,900 crore of slippage we have seen. Out of this, around 900 crore is an MSME book and 600 crore is on a agri book and 400 crore in a retail book. So there are 2-3 reasons for that. First, out of 1,900 crore, post 30th June, we recovered around 300 odd crores. Second point is that in the first quarter, you see that the seasonality is also involved here. Second one, heat waves, election, all these things are factored, and therefore there is a slightly higher slippage, and we are recovering this. But we do not have much of a concern because we are maintaining the collection efficiency of 95%, or in SMA1 and SMA2, which was 0.48% in 31st March, has now come down to 0.47%.
All right. So we leave it there, Mr. Jain. Thank you so much for joining us on ET Now. Actually.